A massive shift is happening right at the very heart of our financial system. And this is a change that goes way beyond just who's sitting in a particular chair. We are talking about a complete rewrite of the rulebook for the U.S. Federal Reserve, and it has huge implications for the markets, for your savings, for everything. It all comes down to one brutal truth.
For as long as I can remember, we've all been told the Fed has one job, right? Fight inflation. Well, that era is over. A bigger, much more powerful force has taken over. The sheer, crushing weight of $35 trillion in government debt. This quote just nails the new reality. The Fed's #1 mission isn't price stability anymore. It's making sure the government can pay its bills.
So all the headlines you're seeing, they're focused on the nomination of a new Fed chair. But if you're only looking at the person, you are missing the much, much bigger story. The real story isn't just about a change in leadership, it's about a change in the Fed's entire reason for existing.
All right, so let's meet the man at the center of this storm, Kevin Warsh. If he gets confirmed, he'll be the wealthiest Fed chair in American history, with deep, deep connections to Wall Street and Washington. That tells you he's a guy who is comfortable with immense power. But the real question isn't just about his philosophy, it's whether any philosophy can survive what's coming.
And this right here, this shows you just how massive the change could be. It's like night and day. The Powell era was all about reacting to the latest data point and, of course, the famous Fed put, that unspoken promise that the Fed would always be there to save the markets. Warsh is signaling something totally different, shrinking the Fed's role and getting back to fiscal neutrality, where the Fed's only job is fighting inflation. At least, that's the official line.
Because here's the thing, and this is the real kicker. It almost doesn't matter who is Fed chair or what they believe. They are walking straight into a trap. And it's a trap that wasn't set by the markets, but by the government itself. It's a concept called fiscal dominance.
It all starts with this number. Just look at it, nearly $2 trillion. That's the projected budget shortfall for the U.S. government for just one single year. Now, to cover that massive gap, the Treasury has to borrow an unbelievable amount of money by selling bonds, and that creates this huge, inescapable problem that lands right on the Fed's doorstep.
Okay, so what is fiscal dominance? Let me put it this way. Imagine the government is driving a bus with no brakes, and it's just flooring the accelerator on spending. Fiscal dominance is the point where the Federal Reserve is forced to become the gas station, endlessly refueling that bus to stop it from crashing, even if the fuel it's using is superinflationary. The need to fund the government simply overrides everything else.
And this creates a vicious cycle, right? A four-step doom loop, basically. Step 1, the government spends way more than it brings in. Step 2, to pay for it, the Treasury has to issue this ocean of bonds. But what happens when there aren't enough buyers? Well, at Step 3, the Fed gets pressured, maybe even forced, to print money and buy those bonds itself, just to keep interest rates from exploding. And the result? Step 4, the inflation mandate gets thrown out the window. The government has to be funded no matter the cost.
Okay, so we're stuck in this trap. What's Kevin Warsh's big idea to get us out? Well, his supporters say he's got this radical new playbook, something designed to break this cycle and finally restore the Fed's credibility.
All right, let's unpack what this Warsh doctrine actually means. First up, active quantitative tightening, or QT. This is a big one. Instead of just letting old bonds expire, the Fed would actively sell them. That's pulling money directly out of the financial system. Second, he wants to end what he calls mission creep. He argues the Fed has gotten sidetracked with social policies and wants to refocus it only on price stability. That's the fiscal neutrality part. And finally, he's talking about a new accord for better coordination between the Treasury and the Fed.
But, and this is where it gets really interesting, there's a huge contradiction here. See, the last time Kevin Warsh was at the Fed, he was a famous hawk. I mean, the guy was constantly warning about inflation. Now suddenly he's sounding a lot more like a dove, talking about how AI is going to create so much productivity that we can have lower interest rates. So, which one is it? Is he a hawk? Is he a dove? Or is this all just a calculated move to deal with the political reality of that fiscal dominance trap?
So while everyone's trying to figure out the real Kevin Warsh, you know who's not waiting around? The bond market. The so-called smart money. It's already moving, and it is sending a very, very clear warning signal through the price of long-term government debt.
Now, to get what's happening, you need to understand something called the term premium. Seriously, just think of it as hazard pay. It's the extra money, the extra interest that investors demand to lend to the government for 10 or 30 years. It's a direct measure of their fear that the Fed is losing its independence, and fear that inflation could just get out of control. The more fear, the higher the term premium. Simple as that.
In this chart right here,
This is that fear, visualized. Back when Warsh was a hawk, the 10-year Treasury yield was about 3.5%. But look at today. Even with all this talk of rate cuts, the yield is way higher, at 4.25%. That gap? That's the term premium. The market is already demanding more money for the risk that the Fed's hands are tied. And it's pricing in what they call a bond riot scenario where yields could spike over 5%.
And look, this isn't some slow, gradual thing. The market is basically on a knife's edge. This is data from just 1 week. Geopolitical tension in Hormuz, yields spike. A rumor of a ceasefire, they drop. A naval vessel gets seized, they shoot right back up. The market is this fragile because its anchor, a predictable, independent Fed, is pretty much gone.
Which brings us to the million-dollar question, or maybe the trillion-dollar question. What happens if Warsh actually gets in there, tries to play the hawk, and starts aggressively selling bonds to prove the Fed is credible, but in the process, he actually breaks the bond market?
This is what's known as the yield curve control paradox, and it is a huge deal. Imagine this. Warsh tries to act tough. The bond market panics. Investors dump their bonds and interest rates go through the roof. If rates hit a point where the government literally can't afford its interest payments, say 7 or 8%, the Treasury would have no choice. They would have to step in and force the Fed to do the exact opposite of what it wanted, to print trillions of dollars and buy up bonds to force rates back down. His attempt to prove the Fed is independent would ironically trigger its final and total loss of independence.
So what does all this mean? Well, all this complexity and risk has created this huge disconnect in the market. Right now, there are two completely different games being played. There's the game that retail investors are playing, and then there's the game that professionals are playing.
On one side, you've got the retail bet. It's pretty simple. They hear Warsh talking about AI and maybe cutting rates, so they're buying the dip, thinking the old playbook still works. But on the other side, you've got the pros, and they see something totally different. They see the fiscal dominance trap, and they understand that the Fed put is dead. They're positioning for a world where interest rates stay higher for longer, not because the Fed wants them to, but because they have to, just to find enough buyers for all that government debt.
And that right there, that is the brutal truth of the situation. This is the one thing you have to understand. Higher for longer isn't a policy choice anymore. It's not the Fed trying to fight inflation. It's a structural, mathematical necessity. To fund its massive deficits, the government simply needs higher rates to attract enough lenders. Period.
Okay, so why should you personally care about all this? How does this actually affect your 401k? Well, first, the safety net is gone. The Fed put that has propped up the market for a generation is being taken away. Second, if a Warsh Fed starts actively selling assets, that active QT, it's like a vacuum cleaner sucking liquidity right out of the system, which almost guarantees more volatility for stocks. Analysts are calling this whole transition the Warsh shock, a fundamental shift away from supporting markets.
And it all boils down to this one final, really sobering question. For decades, we all believed the Federal Reserve was in charge, the one who set the price of money. But in this new era of fiscal dominance, we have to ask ourselves, is the Fed still in the driver's seat, or has it become a passenger in a bus that's being driven by the government's insatiable need for more debt?